Have you ever thought about this? Two people sell real estate that looks almost identical. Same year, same market, even similar profit. But when tax time comes, they pay completely different taxes. One person gets capital gains treatment. The other gets taxed as ordinary income and may even face self-employment tax on top. And this is not luck, not a software issue, and not just different accounting choices. It comes down to one thing. In the eyes of tax law, what kind of property was this? Welcome to Ivy Smart Tax and the Tax Decode series. Today, we break down investor versus dealer versus developer.
So this is one of those same profit, totally different tax outcomes?
Exactly. And in real estate, that difference can be massive. So here's the real question. How does the IRS actually decide this? At the core, there are three categories: investor, dealer, developer. But here's the key. The tax law does not care what you call yourself. It focuses on three things: how the property was held, what it was held for, and how you intended to make money. In other words, you don't become an investor just by saying it. Your behavior determines your classification.
So tax law isn't looking at your title. It's looking at the role the property plays?
Exactly. And once that role changes, the tax outcome can change with it. Let's start with the category most people want: investor-type property. In this situation, the property is typically held for long-term appreciation, often with rental income, and not primarily for quick resale. If the facts support that classification, the property may be treated as a capital asset under IRC Section 1221. What does that mean? It may qualify for capital gains treatment instead of ordinary income, and in many cases, it is not subject to self-employment tax. It may also allow access to deferral strategies like IRC Section 1031, but only if the property is truly held for investment or business use, not held for sale.
So it's not just what you want to be, it's what you can prove?
Exactly. Wanting investor treatment and proving investor treatment are two very different things. Now let's look at the side most people don't expect: when your deal stops being an investment and starts being treated as a business. Under tax law, if a property is held mainly to sell to customers as part of your normal activity, it is not treated like an investment. Think of it like this: if you buy a stock and hold it, investment. But if you run a store and sell products, inventory. Real estate works the same way. If you are regularly buying and selling, the IRS may say, "You're not investing, you're running a sales business." And that changes everything. Instead of lower capital gains tax, you get taxed at higher ordinary income rates and possibly self-employment tax.
So it's not about the property, it's about how you use it?
Exactly. Same property, completely different tax. Now, let's move into the most confusing area: development. A lot of people assume if I improve a property, it's still an investment. But that's where problems start. Because once your activity starts to look like this: building, major renovations, subdivision, preparing for resale, the IRS may start asking, are you really investing, or are you creating property to sell? And that distinction matters because it can push you from investor into dealer treatment. There's also a second issue most people don't see: timing. Many development costs are not immediately deductible. Instead, they must be added to the property's cost and recognized later when the property is sold. So now you're facing two changes at the same time: higher tax rates and delayed deductions.
So you're getting hit twice? Higher tax and slower tax benefits?
Exactly. That's why development is the gray zone where tax treatment can shift very quickly. At this point, most people ask, so what's the rule? And here's the honest answer: there is no single rule. The IRS is not judging one deal, it's looking at your overall behavior, your intent, how long you hold properties, how often you do this, how much work you put in. None of these decide it alone. It's how they fit together that determines your classification.
So it's not one factor, it's the full story?
Exactly. And over time, that story becomes a pattern. One deal doesn't define you, but repeated activity does. Buy, improve, sell, and do it again and again. At that point, the IRS may no longer see investing. It may see a business.
So even a few deals can start to change how you're treated.
Exactly. Because repetition shows intent, and intent drives classification. Here's one of the most important ideas in real estate tax: the IRS cares more about what you do than what you say later. You can say, this was an investment, but if your actions show you bought the property, you made major improvements, you actively marketed it, and you sold it quickly, then your behavior tells a completely different story, and the IRS will follow your behavior, not your label.
So this is one of those situations where someone says investment, but everything they did looks like a sales business.
Exactly. And here's the part people don't realize: the IRS is not impressed by explanations after the fact. Saying, I meant it as an investment, is much weaker than showing consistent behavior that supports that claim. That's why real tax planning is not just about what position you want to take later, it's about making sure your actions support that position in real time. Now let's shift from understanding the problem to how real tax planning works. Most people think tax planning happens after the deal, after the sale, after the numbers are final, right before filing. But that's too late, because by then, the facts are already set, the behavior is already done, and the tax result is mostly locked in. Real tax planning happens before the deal. It happens when you decide why you're buying the property, how you plan to use it, and how you will eventually exit. And there are three things that control the outcome: intent, structure, documentation. Intent is your plan, structure is how you set it up, documentation is how you prove it.
So the goal isn't to explain it later. It's to build it correctly from the start.
Exactly. You're not trying to convince the IRS after the fact. You're making sure your situation actually makes sense from the beginning. That's what separates real tax planning from expensive mistakes. Here's a major mistake that causes a lot of tax problems: trying to change the label after the fact. Some people think, if I lose money, I'll call it inventory. If I make money, I'll call it an investment. But tax law does not work that way. You cannot switch your classification just because the tax result changed. Because the IRS is not just looking at this deal, it's looking at your history: how you reported before, how you treated similar properties, how consistent your story is. And when your position starts to change depending on what benefits you, that creates a red flag.
So the problem is trying to get the best of both worlds.
Exactly. And here's the bigger issue: once your reporting becomes inconsistent, your credibility drops. And when credibility drops, every position you take becomes harder to defend, even if some of them are actually valid. That's why consistency is not just a technical rule, it's a protection strategy. At this point, everything comes down to one thing: proof. In tax, intent alone is not enough. If you can't show it, the IRS won't rely on it. So here's a quick check: do you have records showing your original plan? Do you have activity that supports that plan? And does your timeline make sense from start to finish? Because documentation is not just paperwork. It's what turns your intent into something the IRS can verify.
So it's not what you say, it's what you can show.
Exactly. And when everything lines up, your position becomes much stronger. Now let's bring this together. What actually happens if classification goes wrong? Most people think the worst case is simple: I just pay a little more tax. But it can be much bigger than that. Because once classification changes, everything connected to it can change. You may lose capital gain treatment, which means higher tax rates. You may lose 1031 exchange eligibility, which means no tax deferral. You may lose installment sale flexibility, which affects how income is spread. And instead of investment income, you may now have ordinary income, potentially with additional tax exposure.
So it's not just one number changing, it's the entire tax outcome?
Exactly. This is why classification is so important, because it doesn't just affect one line on your return, it affects the entire result. And that's where the real cost is. Let's bring it all together. Investor may qualify for lower tax treatment. Dealer is generally taxed as ordinary income. Developer depends on the full pattern of activity. And here's what most people miss: the line between these categories is thinner than you think. It's not just what you planned, it's what your actions actually show over time. So here's the real question: if the IRS reviewed your deals today, what story would your facts tell? Because this difference is not small. It can mean paying tens of thousands more, or even hundreds of thousands. That's why smart planning doesn't happen at tax time. It happens before the deal begins, when you align your intent, your structure, and your documentation. If you want more clear CPA level explanations like this, follow Ivy Smart Tax. We help you understand the rules early so you don't learn them the expensive way.
That's the real win. Not fixing it later, but getting it right from the start.